Hello, friends. Good evening, everyone. I welcome you all to this live session of ICI on the subject of financial management. I suppose this is the first session of financial management that you guys will be attending. So, I'm going to open up this subject for you with a very introductory part in today's session. First, we're going to cover the scope and objectives of financial management, and then we'll go ahead with the sources of funds. Okay. Scope and objectives of financial management, we are going to cover in the first half before the break. We'll take a break of 5-10 minutes in between. And then in the second half, we'll proceed with the various sources of funds. Okay. I once again welcome you all with my full heart to this session. We're going to have this as much as possible interactive session. I'll be taking your feedbacks from the chat box, and we'll try to respond almost all the queries that I see on the screen. And you also, guys, be free to put up your queries so that you leave this session without any doubt in your minds. Okay. So let me just open up this subject for you without much discussing about anything else. Let's just talk about this subject, financial management, the subject of financial management. I suppose you are looking at this subject for the very first time, because this subject is a new one to you. It has never been taught to you in your school days, probably, or maybe in your 11th and 12th commerce also. And we didn't have it in our foundation course also, right? So there's a uh, totally new subject for us, and let's just try to uh, you know understand the subject in detail as much as possible in today's session. So first, let's talk of this subject, financial management. Now, out of this, I would like you to you know catch this word of management. Okay, so if I ask you, what do you mean by this word management? What do you understand by this word management? I want this session to be as much interactive as possible. As I said, you should be leaving this session without any doubt. So I'm asking you, what do you mean by this word management? Yeah, I'm pretty sure a lot of you will, speak out the definition given by Henry Fayol. It's a task of, it's a activity of getting the things, art of getting the things done from others, or maybe some other management guru's definition you might have learned in your school days, or maybe in just couple of last years. But talking about this subject, when I ask you what is this management as a activity, what is the set of activities that a manager does? Can any one of you just point out what sort of activities does a manager does? It may be a finance manager, it may be a HR manager, it may be a production manager. Yeah. So, what do you mean by the management task? What sort of task that a manager does? Okay, so let me look at the answers. I'm getting some answers as it's a systematic arrangement. Okay, planning, organizing, controlling. Okay, how to get the work done by others, to supervise, administration of business. Uh, Nanesh, it doesn't mean only administration of business. It need not be a business. When you talk of management, it involves a lot of other things also, because all those non-profit organizations do have a management, right? So they also undertake the activity of management. To simply put in words, guys, if I tell you, management involves just two tasks. Management involves just two tasks, guys. And which are those two tasks, sir? First task, I would say that manager does is basically getting the resources, right? Or the The activity that a manager does is getting the resources. So the first activity that a manager does is raising the resources. Okay. Yeah. Raising resources. That is the first activity that a manager does. Now, what is the manager going to do with those resources? What is the manager really going to do with those resources? Is he going to use it for his personal purpose, or what is the whole objective of getting the resources? What's the purpose of getting the resources? Of course, he needs to utilize those resources somewhere, right? So it's just not only raising of resources, but the management also involves another task, which is utilizing resources, correct? So this also means not only raising of resources, but also utilizing the resources. Okay. Now, if you talk of any manager, the task performed by them involves only these two things: raising of resources and utilizing of resources. Talk of any manager, be it a production manager, the task of the production manager will be to get the raw material, to get the raw material, to process it and then sell it in the market, right? Uh, or getting the right things, sort of getting the right raw material, getting the right labor, raising of those resources, and then putting them into the action in the form of utilizing those resources. So production manager looks after raising production resources, utilizing them, and producing the finished product. HR manager raises the human resources. It gets the manpower and appropriately employs them at respective places. We talk of sales manager. He gets the salesmen and allocates them into respective areas. Correct. So when we talk of management, understand that it involves primarily these two activities: raising of resources and utilizing of resources. So if it raises resources, it's going to utilize in some other way. And obviously, whenever you're raising the resources, what will be your objective? Sir, my objective when I'm raising the resources would be to get the resources at the lowest possible cost. And when I'm utilizing the resources, my objective will be to use them with the maximum efficiency, with almost nil wastage or minimum wastage, and maybe coming out with super, I can say, great output in the form of good sales, in the form of high quality products, right? So that's what the management task is, right? So we can simply say that management involves these two simple tasks. Okay. So these are the two simple tasks which a manager does: raising resources and utilizing the resources. Correct. Now, coming to the other word, coming to the other word, financial management. Now, when we hear the word finance, what does it really click in your mind? What does that mean in your mind whenever we say finance? The finance means it comes from the word funds, so it must be related to some money. Yeah, so very much perfect. You are absolutely correct. So when we talk of financial management, can you say what does this combination of word mean? What would a combination of these two words mean of activities? So what sort of activities would be involved in financial management? If management means raising of resources and utilizing of resources, what would financial management mean, guys? What would financial management mean? What would that be meaning? Financial management. Yeah, correct. It is like raising of the funds, and utilizing the funds. Right? Absolutely correct, guys. Most of you are giving the absolutely correct answer. Yeah. So whenever we say financial management, it means raising of funds and utilizing of funds. Correct? Absolutely true. So over here, we mean, so this word financial management, this word financial management actually means two activities are getting involved. Which are those two activities? Those two activities are simply raising funds and utilizing funds. Raising funds and utilizing funds. Now, when I talk of raising funds and utilizing funds, I want you to respond how and from where can I raise the funds? Tell me, guys. How and where and from where can I raise the funds? What are the ways of raising the funds? And what are the sources from where I can actually get the funds? Yeah, I'm waiting for your answer, guys. Yeah. So I'm getting answers as the raising funds from equity, shares, from debt, okay, through share capital, issue of debentures, issue of shares, borrowed fund, owned funds, okay, raising capital through borrowing, angel investors, okay, a lot of answers, absolutely correct. But if I tell you what are the broadly two categories from which we can raise the funds? There are broadly two categories from which you can raise the funds. Tell me, guys, which are those two broad categories from which we can raise the funds? Which are those two broad categories from where we can raise the funds? Two broad categories. Two broad categories from which we can raise the funds. Yeah. Two broad categories from which we can actually raise the funds is term loan, security, members and creditors, equity and debt. Okay, who's this equity and debt answer? Karthik and Ankit. Even Shreyas Parshar has given correct answer. Vaishali has given correct answer. Equity and Geet has also given correct answer. Okay, so absolutely correct. You can raise the funds with two ways, two sources. One is by way of you can raise the funds. One by way of owned funds, and the other can be borrowed funds, right? And when it comes to utilizing the resources, where can you invest your money? Guys? Which are the areas broadly in which you can invest your money? Yep, tell me. Which are the areas broadly in which you can invest the money? Which are the areas broadly in which you can invest the money? I would like to give you a hint. Try to take a cue from the balance sheet. In the balance sheet, you will find that the funds are invested, but where are they really invested? Where are they really invested? What are the broad categories of your in which your funds are invested? Yeah. Which are the broad categories in which the funds are invested? Assets, okay, but then balance sheet. I'm taking off. I'm asking you to take a cue from the balance sheet. Yeah. Okay. Let me just help you. Funds are basically going to be employed in three broad categories. You can have the investment in fixed assets or into your working capital, correct? Or into your non-operating investments. Non-operating investments. So you can have your investment in any of these three areas. Either you will put your money into some fixed asset like a plant and machinery, or you will put your money in some short-term assets like raw material, or some money lying with your debtors or bank balance, uh, or you may make some non-operating investment which is not related to your business. That is, you can buy some shares, you can buy some mutual fund, you can buy debentures of certain company, right? So that these are the two main activity which the fund manager does. So any finance manager is supposed to be doing these two set of activities. One is getting the funds uh, from owned or from borrowed, and other is utilizing those funds into fixed asset, working capital, or non-operating investments. Now over here, our entire financial management course at CA Inter level, it is purely dedicated to this activities of a fund manager, of a finance manager. All the chapters that we have are actually focused about each of these items. So let me quickly, in next 5 minutes, uh, run you through the chapters and which are the areas on which this is being, or the chapters which target each of these areas. So first of all, we would like to say, sir, which are those areas which are impacted by, owned funds and borrowed funds? Or I can say, which are the areas which tell us about raising of resources? There is a chapter which will tell you about which fixed asset to purchase. There are certain chapters which will tell you how to manage your working capital. And this non-operating investments, it's a separate, all of a different kind thing, which is going to be covered in multiple chapters in stepwise. So let's talk of one such area. Okay, so this one, from where to raise the funds. So for that purpose, we will say where to raise the funds, which are the chapters that it deals with. First of all, how will you decide whether you will issue equity shares or whether will you take a loan, or even if you want to take a loan, from where you are going to take a loan? How are you going to decide? So there are offers from multiple banks or multiple ways of raising funds. Which option of raising the funds for your business will you choose? What is the base on which you're going to decide? Can I say you will try to get the funds from those sources, or those sources which uh, in which your cost is going to be the lowest one. The cost of getting the funds should be the lowest one, correct? So that's what we have the chapter. One of the chapters that we have is cost of capital. Okay. So we have this chapter of cost of capital. There is one chapter in which we tend to calculate the cost of each type of capital, which would be like cost of the equity share, cost of the term loan, cost of the debenture, cost of the preference share. All those costs are calculated, and we will be selecting that typical area from where we can get the cost easily, and those source of funds will be chosen, which is having the lowest cost, which is quite obvious. So first step that we need to look at is how do we calculate the cost of capital? Second, after calculating the cost of capital, I would like to know how much owned funds I should have in my business and how much borrowed funds I should have in my business. Because a business will require both of them or maybe only equity. So that decision needs to be taken. How much equity should I get? How much debt should I get for the efficient running of my business, for maximizing my shareholders' wealth? And that's the chapter that we have, which is capital structure. The next chapter that we have is capital structure, which tell us how much owned funds and how much borrowed funds I should have. Okay. Now, of course, when we are getting those funds, it also involves a risk, right? So we need to understand how the risk is to be calculated, operating level, what sort of activities you are doing, what sort of activities, what sort of business you are doing, and secondly, the funds that you are raising. So simply, we need to look at the risk of this sort of funds also, right? So risk is another area which we need to cover up, that is going to come in between this, that is in between raising of funds and utilization of funds. Now, to look into this aspect of fixed assets, which fixed assets to be purchased, whether fixed assets should be purchased or not, should I purchase the fixed asset or should I just go ahead with a manual activity that is to be done. So to look after that, we have chapters called as investment decisions. It is also called as capital budgeting. Prominently is also said to be capital budgeting. This is one such chapter, guys. So investment decision is the chapter which is going to help us in deciding which is going to help us in deciding which machine to be purchased. Like if I have a choice of getting machine 1, getting machine 2, machine 3, out of 3 machines, which machine is to be chosen? Or maybe if I want to decide which, whether I should buy a new vehicle or whether I should buy an old vehicle. So all those sort of fixed asset decisions will be taken in this chapter of investment decisions. Connected with this is we have a chapter of risk analysis in capital budgeting. Risk analysis in capital budgeting. So this is again a new chapter. This is a second chapter, which is with related to fixed assets. So even in fixed assets, we would we would like to know as to, what is the risk involved in those assets, right? So that's where we have about fixed assets. Then for working capital thing, we have a whole full chapter of working capital management. We have a full chapter dedicated to this working capital. So the chapter name is Working Capital Management. In that, we have multiple other small chapters, small topics, in which we decide how much credit period is to be given to the debtors, whether we should maintain a good amount of stock or whether we should be working with the lowest possible amount of stock. So all those things are going to be covered in this working capital chapter. Okay, so fixed assets, we have investment decisions, risk analysis and capital budgeting. Working capital, we have this chapter of working capital management. Then, as I said, there are certain portions that we need to look at in holistic view. So in the form of holistic sense, we say we don't only raise the funds, but rather we're also going to utilize the funds. And the risk that an entity faces is not only from the funds that it has raised, it actually faces the risk from the point of view of the business it is doing. Now, if I ask you, There is a company which is into FMCG sector, which is into FMCG sector. I hope you understand FMCG sector, right? Fast moving consumer goods. And there is a company which is into the airline industry. If I ask you out of these two companies, which is doing a more risky business, is it the FMCG sector or is it the airline industry? I'm talking of risky from the point of view of macroeconomic scenario. So from the macroeconomic point of view, what do you think? Which company is doing a more risky business? Is it the FMCG one, or is it the you know uh, the aircraft operator? Airline, right? Airline is more risky because it is subject to market fluctuation. If the global wealth or the global GDP goes down, people would prefer less travels by airline. So their business gets affected. Whereas FMCG is not going to be affected because FMCG is a business which is like a day-to-day consumption, right? People won't be staying at home without brushing their tooth or without washing their hair, without using the soap. So during the COVID times, also you might have realized that when we are at home, uh, when we were not all at home, we were. It was not that we were not utilizing the FMCG products, right? Now, some of you may argue, sir, we were staying at home, without bathing without taking bath, maybe probably for 3 or 4 days, but that doesn't sound to be good. Okay, so anyways, there are some outliers always. Okay, I am just stating this because some of them have answered that FMCG is more risky. So FMCG is not risky, guys, because it's a thing which is a mass consumption. It's an industry which produces goods which are consumed on a regular basis. Okay. Now, so as I said, there's a risk that comes from the business. Apart from this risk, which comes from the business, apart from this risk, which comes from the business, so as I said, risk is coming from both sides, from the business, is coming from uh, business, and also the risk is arising from the financing pattern also. Okay, the risk is coming from business as well as from the financing pattern. Okay. Yeah. So we said about business, now talking about financing pattern. Tell me, guys, if I go for a owned fund financing or if I go for a borrowed fund financing, which is having more risk than financing, you can go for more debt or more equity. Which one do you think is a more risky proposition? Naina Kaushik is repeating, FMCG has more competition now. So that is also risk for new entrant. FMCG is having more risk, more competition. So what? Your business is not going to go down because of macroeconomic scenario. And I have just said that it was about macroeconomic scenario. Okay. So more competition doesn't mean more risk, essentially. Which is more risky, guys, when it comes to raising of funds. But naturally, it is the debt which is more risky. To take more debt, it's quite risky, right? It is definitely more risky if you take more debt. Borrowing debt is more risky. It's a very simple thing to understand. Let's say you buy a house property. Okay, suppose you buy a house property, and for that you are there's a project, right? There's a project for you. You get a house property. You get a house property worth, let's say, 1 crore. You get a house property worth 1 crore, and this 1 crore you can do it in two ways. So, first option for you is to go for 80 lakhs owned funds, 20 lakhs borrowed funds. Okay. And the second option that we have is 20 lakh owned funds and 80 lakh borrowed funds. Now tell me, guys, which option is more risky? Which option is more risky? Which is a very layman thing. Anyone would say, sir, it is this particular option that's going to be more risky, right? Because over here, this is supposed to be more risky, right? Because you're taking 80 lakh loan. So if you're going to get the funds by more of a loan, it's a burden on you to repay it back, right? So your business will be stressed out to pay interest essentially. The business will be stressed out to pay interest. And if you won't be able to pay the EMIs on time, what would happen essentially is you may need to apply for liquidation possibly. Right. So therefore we say risk as a whole, risk, it comes from business and also from financing. Business risk is based on the macroeconomic scenario, and financing pattern is dependent on how much debt or how much equity you take, right? So how much risk a typical company can take, that will decide how much debt it is going to take, right? Okay. So the other set of chapters that we have over here in the subject, which involves understanding the risk and return. These are the next two set of chapters that we have. The next set of chapters that we have is one is the ratio analysis. Ratio analysis, and the other chapter is leverages. Okay. So these two chapters help us in understanding the risk and return of a typical business, right? So these chapters are meant to realize or calculate how much return we are earning and how much risk we are essentially taking. So, anyways, the next lecture that we have, the next session, that is going to be on ratio analysis, which is going to be a numerical analysis of a company's financial health. So, this is the whole subject that we have: getting the funds, utilizing the funds, managing the risk and the return, right? So, ratio analysis is calculating of certain numbers. Leverages, again, it is measuring the business risk and the finance risk. Leverages is a way, or it's a topic which will help us in understanding how to manage or how to measure the business risk and the financial risk. Okay. Yeah. Are we clear till now, guys? I hope we're clear till now. Yeah. Let me go through the queries if there are any. No. Okay. Now, coming to this subject, taking this subject a bit further, I would like to say about the various phases in which this subject has essentially evolved. Okay. The phases in which the subject has actually evolved. So if we talk of evolution of this subject, because any subject matter of study, it actually evolves over a period of time historically. So there are three phases that you observe in this subject. One is a traditional phase, the other is a transitional phase, and then we have the modern phase. Now, traditionally, financial management was more of referred thing in case of any takeovers or in case of any mergers, right? Or in case of any other activity like any liquidation of a company, or maybe in case of any expansion of a company, expansion of a project, right? It was traditionally financial management was restricted to that area. Then in the transitional phase, uh, day-to-day activities were also getting involved. Day-to-day activities are also getting involved into this subject. So day-to-day managing of funds, day-to-day, managing the bank balance, managing the cash balance, then decision about making payment to creditors or collection from debtors. Those all were also included over here. So day-to-day activities are also included over here. Now the modern phase that we have right now, which is going on. So modern phase that we have, that is more of about capital budgeting decision, which is simply deciding which project is to be undertaken, which machine is to be purchased, right? Then it talks about company valuations now, right? So then share market pricing, or going for some futures and options. So all these are advanced things. So basically, what we have in our inter syllabus is this some portion of traditional finance, more of a transitional finance, and then we have certain modern phrases, modern phase answers for also this financial management. Okay, so that's a evolution of financial management. Now, if I ask you uh, value of a company, value of company, it is dependent on broadly three things. Okay, it is basically, we can say it's a function of your investment decisions, your financing decisions, and your dividend. So investment decisions means capital budgeting, working capital management, where to put your money, when to put your money, when to withdraw your money, right? All those decisions are about this investment decisions. The financing decision is from where to get the funds, how much debt, how much equity, right? And then the final area is how much dividend we should be really be paying. Because if we pay a lot of dividends to our shareholders, and tomorrow when we need funds for expansion, we may fall short of it. So how to decide the how to decide how much dividend is to be paid? That is again going to have a implication on the valuation of our company, right? So whenever I say valuation, I hope you get a idea about Shark Tank, right? I hope you guys are following this series that we have, right? Shark Tank, correct? Are we watching it? So you might be getting these terms of equity, valuation, correct? Am I able to connect to you? I hope that you're watching this series of Shark Tank in which the businessmen come to those investors and they raise funds, and they say that the value of our company is so many crores or so many lakhs. Now, their valuation that they say, ultimately it is depending on these areas, that what business are they doing, where they have invested their money, how they have raised those money. Now, dividend part comes at a later stage, at an advanced stage, right? Okay, so that comes at an advanced stage. But value of any company is dependent on where it has put off money, where it has put the money, and from where it has got the funds. Now, whenever we talk of this valuation part, we need to look at what should be the objective of finance manager. What should be the objective of a finance manager? Suppose if you are appointed as a finance manager, what is your objective going to be? What would you like to do? Or whatever activity we do, like raising of fund, putting or investing of money, what is the ultimate objective that we have? What is the ultimate objective that we have? Tell me. What is the ultimate objective of you know doing the task of a finance manager? Okay. So whenever we look at the objective, broadly, it has got to be two parts. One is said to be the profit maximization, and other is wealth or value maximization. Okay, profit maximization and wealth or value maximization. Now, right now, the focus is on wealth maximization or value maximization and not on profit maximization, because profit is a very narrow term. It's an age-old thing that we need to do business for profit maximization. But right now, the trend that we have is wealth or value maximization. So, sir, what is the difference between value maximization and wealth maximization? Right? So, what's the difference between profit maximization and wealth or value maximization? So, let us talk of first profit maximization. So, this profit maximization, uh, there are certain shortcomings of this objective. The first shortcoming that I can say, the profit is a vague figure, right? Profit is a vague figure because the way you calculate profit, that is quite vague, right? Because my business may be depreciating asset at some rate. The other business would be depreciating, its assets at some different rate. I may be having some good intangible value. The other company may not be having some good intangible value. So the amortization of those intangible value may also affect my profit, right? So vague means it's not clear. It's basically not clear which profit are you talking. Are you talking of I should maximize the earnings before interest and taxes? I should maximize my profit before taxes, or I should maximize the profit for my shareholders? So calculation of profit is a vague thing because there are many estimates, many judgments that you take while calculating a profit, right? You estimate that the machine will run for so many years, and then you calculate the depreciation. You sell the goods, you realize it in sales, and then you estimate whether you will realize that money from the debtor or not, and then you create some provisions. So there are certain things which are not crystal clear, right? If I prepare the final accounts and some other guy prepare the final accounts without giving you the adjustments, okay, you will say, sir, adjustments are same, the balance sheet and P&L should be also same. No. If you are given the trial balance and you are being told that you apply your judgment, prepare a balance sheet and P&L, okay, prepare a balance sheet and P&L, apply for your judgment, how much year the machine may be used, use your own judgment for rate of depreciation, use your own judgment for creation of provisions. Do you think that both the participants who are preparing the final accounts, are you going to get the same profit figure? If I'm not giving them a standardized rate of depreciation, a standardized rate of provision, do you think that both of their judgments will match and the profits will also match for both of them? Do you think it will be the same for both the parties? No, of course, that will be different because my judgment about depreciation, the other party's judgment about uh, provisions or depreciation, that will be different. The profit will vary, and that's where we say that profit is a vague figure, sir. It's not a clear figure that everyone is going to get the same profit. Correct. So even in audit, you might have learned that we give a professional judgment as to whether the financial accounts are giving you true and fair, right? We never say it's true and accurate. We say it's true and fair view, right? So judgment of every person is going to be different. Therefore, the profit that you get is also going to be different. Correct? Now, the second area in which this profit maximization suffer is uh, you need to also consider the risk involved in it, right? So generally, if I ask you risk and return, do they move in the same direction or in the opposite direction? Do they move in the same direction or opposite direction? Risk and return. Yeah. Do they move in the same direction or opposite direction? The risk and return. Of course, in the same direction because higher risk means higher returns, right? So to earn higher profits, obviously the finance manager would like to take higher risky projects, right? Because high risk, high return. That's pretty simple, right? Uh, so when you consider profit, you also need to consider the risk involved in it. Risk consideration should be also there. So profit maximization, in case of profit maximization, we need to consider the risk also, right? So higher the risk, higher will be the return or higher will be the profit. But when we talk of profit maximization, understand your profit maximization cannot go along with higher risk. So if you're targeting high profits, you're also going to take high risk. Okay. So I want to make billions of dollars, sir. I'm ready to take as much risk as I want. So go ahead with the Bitcoins, go ahead with the cryptocurrencies, right? So those investments are going to be really risky and they have a potential to give you good returns. So on the other hand, I may lose my money. Yes, definitely you can lose the money because if you want high return, you need to have a greater risk. So profit maximization doesn't come with only high profit. It actually talks of there is an underlying risk involved in it also. Okay. So third thing, profit maximization suffers from it does not take into account the time pattern of returns, right? For example, if I tell you, uh, so time pattern not considered, uh, if I give you two options, profit of rupees 10,000 and another is profit of rupees 12,000. Profit of rupees 10,000 and profit of rupees 12,000. This profit you're going to get in 2 years, and this profit you're going to get in 12 years. Which number are we going to choose? Are we going to have the 10,000 profit decision after 2 years or 12,000 profit decision after 12 years? So if you're purely looking for profit maximization, if your pure objective is to look for only profit maximization, so what would an investor do? The profit maximization part, an investor would essentially, this profit maximization part, who wants to, the finance manager who wants to maximize the profit, he would say, let me go ahead with this. But the person who is looking for wealth maximization, he will prefer this because he will say, let me get the profit as of current situation today. After 12 years, I don't know what is going to happen. So if your objective is profit maximization, sir, I should be looking for the 12,000 option because I'm getting 2,000 extra profit. But you're not considering the gap of 10 years. And when you bring that time gap in between, your objective is actually wealth maximization, right? And then we have profit maximization is a very narrow concept. It's a very narrow concept. Right? It's a very focus. It's a very small area in which you're working on. So whenever we say profit maximization, it's not going to be a long-term activity. It's going to be a short-term thing. So it's a very narrow concept. So we have a broad concept of wealth maximization. Now, if I ask you, sir, how do we go about maximizing the wealth? What would you like to do for maximizing your wealth? Tell me, guys. What would an investor do for maximizing the wealth? What would an investor do for maximizing the wealth? Yeah. So wealth maximization for that, what sort of what we need to understand what is the meaning of wealth essentially. So what do we mean by wealth? Remember, wealth over here, whenever we talk of wealth, it is present value of future benefits minus present value of future costs. Present value of future benefits, present value of future benefits minus present value of future cost. That is what we mean by wealth maximization. We are talking of present value of future benefits minus present value of future cost. So if you look at the Shark Tank, the valuations that they bring in, the price, the value at which both the participants agree, it is actually this same idea. They give a typical value by looking at the future potential. If the future potential is good, they take the present value, that is, as of now, what is the value of that business? That is what they compute. And then they say, what is the cost that I need to incur to build up that business? And that's how the value of the company comes in, right? So if we have a company which is getting a benefit of 1,000, right? The benefit of, if I say, for example, let's say this is having a benefit of 1,000 and future cost is like 200. So we assign a value as 800 to that company. Now, obtaining the value, it's not pretty easy because it's been almost more than a century. Research has been done, many work has been done as to how to obtain the value of any business. And it's not a science, it's not a straightforward calculation. There are many ifs and buts, many future forecasting needs to be undertaken, right? But always there is a value assigned to a typical business, and value will be different for different category of investors. A business like even in Shark Tank that you see, there are 4 or 5 sharks sitting over there, the investors. Not everyone is convinced about a typical business, right? It's not everyone is convinced about the business. Some investors, some of the sharks find that a typical business is valuable, and therefore they invest the money. And some of them say no, it is not worth it. So just opt out, right? Right. So we have many memes about that from the season one. We had that very famous guy. All his dialogues were as famous as we can recall, right? So there were rejections. There are rejections because those investors don't see value in it. So same goes even in any business valuation. Not everyone finds that a typical business is as valuable as it seems to be. Okay, so whenever we say value, it is wealth or wealth or value. We say it's a simply present value of future benefits minus present value of future costs, right? So, or we can also say, sir, value is basically number of shares multiplied with market price of each share. Right? We can say the value means number of shares multiplied with market price of each share. Now, if I ask you, sir, under what situation is the market price of each share going to go ahead? Yeah, market price of each share. When is the situation that market price of each share going to go above, or when is the scenario that it's going to grow? Because ultimately, keeping a number of shares constant, if you want to create a value, you need to be working in such a manner that the market price of your share goes up. Right? Market price of shares should go up. Now, under what situation the market price of the shares will grow up? Only can I say when the business is doing good, when the company is able to generate the future benefits at the lowest possible cost. Correct? Yeah. So that is where wealth maximization comes in. Now, of course, if we talk of the some of the advantages and disadvantages, profit is it can be easily calculated. Profit can be calculated by following the set of accounting standards, performing certain judgment. But value calculation is a very tedious task. There are multiple approaches. You will find thousands of way of calculating the value of a business, and one business may be valuable to someone, the same may not be valuable to the other one, right? So there is no relation as such between the investors as to what value they assign, right? Uh, then disadvantages from wealth maximization point of view, we can say calculation is very difficult. And again, all these startup companies, they always run behind the valuation that we want the value of our business to be so and so. We want the value of our business to be a typical value, 100 crores, 1,000 crores, or 500 crores. So because of that, they lead to, they are physically under anxiety and under stress, right? So they are under anxiety, they are under stress as to how do we create the value, because they get funds from an investor, but the next time they go to the investor, they always ask for what is the additional value that you have created. So that creation of value is not an overnight thing. It happens gradually with the success of the business. Business success is not going to be that damn easy. So they need to be working very hard, and that leads to anxiety and stress of the management. Okay. Then that's the objective of our finance manager. Now, if you are not a good finance manager, if your decisions are bad with regards to how you raise the funds, or how you put your business, how you put your money, from where you get the funds, from where you put your money, if your decisions are bad, or everything doesn't turn out to be in the same pattern as you have estimated, what would be the resultant impact, guys? What would be the resultant impact? Suppose I made an investment in some project that's not generating returns as I have estimated. So, what will be the resultant impact? Can I say the business will collapse? Or I can say there will be reduction in the value of the company. Correct? You remember Kingfisher Airlines, right? We are aware of Kingfisher Airlines. That company, that brand has got a immense valuation at one point of time, but some of their business decisions were not good. They focused on offering uh, premium and luxury air travel to our Indian customers. You understand? They are trying to offer luxury to Indian customers, that too in the traveling segment. So that didn't work. That actually backfired. So the flights of Kingfisher Airlines were empty, though they were charging. Fares were definitely higher than what other budget airlines were offering, right? So ultimately, what happened is that business collapsed. Right? The business collapsed, and the business valuation nosedived, and it's no more. correct? On the other hand, if you look at the other airline companies like Indigo, for that case, so Indigo is a profit-making company, and it follows smart strategies. It is the company which is actually doing good business in the airline segment, low cost, full flight, right? No additional cost, and there are other business strategies also that they use. Uh, Especially you will find that there's a case study that we have in many areas as to why Indigo have more of female cabin crew, or the female participants in the um, air hostesses and all the cabin crew. Majority they find female because their idea was, as the flight takes off, the weight should be lower, right? So on an average, they found that they were saving 100 to 150 kgs of weight on every flight. So that actually led to savings in their fuel that contributed in generating profit. So that's how they are creating value for their business. And that's where the investors are also getting benefit out of it. Not like some Kingfisher Airlines or some other airline which may be offering you a premium or a luxury travel experience, that too to the Indian customers. And Indian customers are typically price sensitive. You cannot offer them a very premium thing at a high price and then expect them to pay. Of course, they're not going to pay for it. Yeah, they're not going to definitely and then pay for it. Now, uh, in a business entity, one last thing that we have before we go for the break is there's always a conflict of interest, because in case of a company setup, there will be a conflict of interest. Now, what sort of conflict of interest are we going to have? See, on one side of the business are the owners. On the other side of the business, we have the manager of the business. And in a professional setup, you will find that these two are separate entities, right? So owners are the persons who own the company, who have the shares of the company. Managers are basically the board of directors, or the general managers that we have in the company. Okay, so there is this conflict. There's always going to be a conflict that we are talking of. Now, as a manager of the business, you would like to have a greater degree of your personal wealth being growing up. Whereas they should be actually working for growing the wealth of the owners. Owners will have the objective of growing their wealth, right? So there will be this conflict. There will be this conflict. Now, for example, uh, if the manager, let's say the salary that we pay to the managers, salary to manager is basically some rupees X plus Y% of investment. Salary to the manager is, let's say, some rupees X plus Y% of investment. Now that rupees X is fixed, but let's say some percentage, maybe 2% also, maybe 2% of the investment that the manager does, investment in the form of a new project or new machinery. Now, irrespective of what is the risk involved in this investment, a manager would definitely be looking for those investments which may be risky also. Now, if you take more risky investment, ultimately the loss is of the owners. The owners are the ones who are going to lose, and not the manager. It's not the manager who's going to lose, because manager will just simply take, it's simply going to be taking up the fixed salary plus the investment, right? So if the pay structure is like this, of course, there will be a conflict of interest. Manager would like to take up as many investment as possible, whereas the investors, owners would be like, no, no, don't invest in such risky things. So there is always going to be this conflict. Moreover, manager would like to maximize this X also, right? Maximize would like to get a more and more salary. And remember, if more salary is paid to the managers, it is ultimately owners who lose. right? Because if managers are generating wealth for themselves, it is actually the wealth of owners which gets eroded because it's a business entity. We're talking of a business entity. From this, owners have to gain, and from this, even the managers have to gain. Now, what business is generating, what a business is generating, that is a constant figure. What a business is generating, that is a constant figure. Business will generate profit of maybe 10 crores. If out of this 10 crores, 2 crore goes to the managers, it is a balance 8 crores which will come to the owners, right? Okay. Now, if this instead of 2 crores, if the managers are asking for 3 crores, can I say 7 crores will come to the owners? So there is always this push and pull between the managers and owners. Managers will always argue for better salary, better pay structure, but ultimately the owners will have to lose their share. There is this relation or there is this conflict, which we call it as a agency problem, because when the managers are working for the business, they want more salary. If they take more salary, profit of owners will get affected. Owners want more profit. If they want more profit, they need to be paying lesser amount of salaries or compensation to the managers. So there is always going to be this conflict, right? So now, can you suggest me, guys, how can I minimize this conflict? Because this conflict is going to affect very badly my business. So I need to minimize this conflict. How can I minimize this conflict, guys? Tell me. Anyone? Can you tell me how can I minimize this conflict? I cannot totally do away with it, but what is the way by which we can minimize the conflict? One way to minimize this, minimize the conflict by first up, manager compensation, manager compensation tied to profits. That is, we will say managers that the amount of salary or amount of compensation that you get will be some percentage of profit. So now, can I say they will start talking of, they will start taking decisions in which they would be creating profit for the company. Moreover, we can also say manager compensation tied to value of business, tied to the value of business, right? Or you can also say you can give them shares to the managers as compensation. So they would be working on, creating value for the business. And as the value of the business increases, even the wealth of the managers would increase. So these are some of the ways of minimizing the conflict. Okay. Are we clear till now? Because I want to go for a small MCQ session right now. Shall we go for the MCQ session? Yeah, guys. 5 MCQs I've just prepared for you to answer quickly. Shall we go ahead? Okay. Let us read for it. Okay. Okay, here we have the first question, guys. Look at it. Which of the following is not an example of financing decision? Deciding whether to issue equity or debt, deciding the debt equity mix, deciding the level of inventory to be maintained, and deciding whether to retain or pay dividends. Which is not an example of financing decision, guys? Tell me. Which of them is not about deciding the finance? Yeah. A, B, C, D. Which one is the correct answer according to you? Option absolutely correct, guys. Everyone is saying option C. And that's absolutely true. Option C is the correct one. How much inventory you need to maintain? That is your investment decision. That is where you're going to put your money, right? One common mistake that you make is looking for, deciding whether to retain or pay dividends. That is a financing decision. That is a financing decision because the question was not an example of financing decision. Okay, fine. Let's go for the second one. Let's go for the second one. Which of the following is not an example of investing decision? Which one is not an investing decision? A, deciding the credit period to be given. B, deciding the debt equity mix. C, deciding the level of inventory. And D is deciding whether to buy a machine or continue with the manual process. Yeah. Which one is the correct one? Is not an example of investing decision. Which of these is not an example of investing decision? Yeah. Uh, B. Correct. It's a debt equity mix. How much debt, how much equity we have to take. The correct answer for that is deciding the debt equity mix. Okay, perfect. B is the correct answer. Then, which of the following indicate the traditional phase of financial management? Yep. Which of the following indicate the traditional phase of financial decision? Which one indicates a traditional phase? Is it managing the day-to-day financial, takeovers and mergers, option pricing, or is it capital budgeting decision? True, guys, that the takeovers and mergers, because in traditional finance, only when it was a case of takeover, the finance manager were called for taking decisions. Okay. Managing day to day is a transitional phase. Option pricing and capital budgeting are the modern phase decisions. Okay. Now, from this, identify the odd one out. Which one is the odd one out? Which one is the odd one out? Yeah. Is it the investment decision, financing decision between term loan and equity, dividend decision, working capital management? Which one is the odd one out? Odd one out is working capital management because all other things are long term decisions. So, which investment to make, how much equity or how much debt is to be raised, or how much dividend decisions to be made are long term decisions. Working capital management is the short term decision. Okay. Working capital management is a short term decision. That's the correct one. Then, value maximization does not mean. What would be the answer for this? 5D. Okay. Okay. So with this, we are done with the first part, guys. So let's take a break right now of 10 minutes. Post that, we'll begin with the sources of funds topic. Okay. Let's take a break now, guys. Take off break. Welcome back, everyone. I hope everyone has made a comeback to the break. Okay, now we are going to look at the other part of our today's session, which is about sources of finance. Now, remember that topic, sources of finance, is quite elaborate in our module, but for your convenience, I've actually prepared it in the form of a chart. So this entire chart covers the whole of the chapter of sources of finance or sources of funds. You just need to zoom into each one of them to get into the nitty-gritties of individual items. Okay, just zooming into it and you are through it, correct? So I think there is some the sharing. I just reshare it once. Share the screen again. Okay, I think you're able to see the shared screen now. Yep. Okay. Yeah. So sources of funds for your convenience, guys. I have prepared this full chart of sources of funds in one slide. Yeah. So in one slide altogether, everything is placed over here. You see this? Everything is placed in one slide. I'll be sharing this file with you after today's class. I'll be definitely sharing this file with you so that you can uh, well, later refer it for your study purpose also. Let's begin with the sources of funds. So sources of funds, as you have answered, guys, it can be owned funds or it can be borrowed funds, correct? And what sort of bifurcation that I've given is also on the similar line, owned funds and the borrowed fund. Okay, see, we have this as the owned funds over here and the borrowed funds over here, right? So whole lot of task has been done in this for your easy understanding. So let's come to owned funds. Now, since we have shortage of time, I would like to run through some of the very common things. Those things which require in-depth understanding, I'll definitely be discussing them. So coming to owned funds. So under the owned funds criteria, you can raise the owned funds through two sources. Either you can get the owned funds from domestic market or you can get the owned funds from the international market. From the domestic market, we get it through equity share capital or from the preference share capital. We are quite aware about what sort of capital are these two, equity share capital and preference share capital. Equity capital is about permanent capital. It represents the ownership. It is high cost of capital, security to the other fund providers. Okay. So equity share capital, basically, it is having the highest cost. Remember, when you're getting funds for your from your equity shareholders, it doesn't mean it comes free of cost. Your equity shareholders have certain expectations and you need to match their expectations. And for that purpose, you need to be earning good profits for them. Okay. So therefore, we say it has got a high cost. It's also going to provide security to the fund providers. That is, if it's like the more owned funds a business has, the more safe situation it is. Okay. Preference shares, we know there are redeemable, participating, non-participating, cumulative, non-cumulative. I assume you might have learned all of them. So I'm not going much into detail of equity share capital and preference share capital because we have other really important things to discuss. So these are the external sources of domestic funds, domestic owned funds. Internally, whatever profits you generate, you can actually accumulate that. So that's actually accumulated profits which are flowed by the company back into the business. Now, these retained earnings, definitely these belong to the ordinary shareholders and it increases the net worth. Okay. So retained earnings are internal owned growth. Now, what we have important discussion over here is about GDR, international level owned funds, but GDR, international level owned funds. We are going to talk about the global depository receipts. International level global depository receipts. Let's understand that in detail. Okay. Global depository receipt. See, let's understand it with the help of a example. In India, we have a company, Infosys Limited. It can issue its equity shares in the Indian market. Right? Infosys can issue the equity shares in the Indian market and get the requisite funds. But it wants to go at an international level and it wants to get money against the shares in the international market. Now, Infosys shares will be listed in denomination of rupee. And if I take my shares, being a Infosys founder, if Narayan Murthy takes the shares of Infosys and tries to sell it in the US market, will any investor in US market buy the shares of Infosys Limited? Will an investor buy? Of course, no, because Infosys shares are denominated in rupee because they are having some currency value. Currency is rupee. US guys don't understand what rupee is. They understand what dollar is, right? So USD, they understand what USD is. So these Infosys guys, this Infosys would like to get the funds against its shares. It wants to issue the shares in the international market, but there is a difficulty because there people don't recognize rupee. They recognize only dollars. So how to get our shares listed on US stock exchange? For that, we have this mechanism called as global depository receipt or American depository receipt. Now, what happens in this process? Infosys basically gives the shares. Infosys gives shares, let's say 10,000 shares are considered. So Infosys gives the shares to a depository in US. Now, who is a depository? Can you tell me who is a depository, guys? Anyone? Who is a depository? Who is a depository? Which entity is said to be a depository? Are we aware of depositories in India? No? Okay. Have you heard entities named as CDSL and NSDL? You've heard about CDSL and NSDL? Perfect, perfect. Yes, CDSL and NSDL, correct. CDSL and NSDL are the depositories in India. Similarly, there will be a depository in US. Now, what is this depository? See, all our shares are basically traded in dematerialized form. We don't have the physical trading of shares nowadays, right? It's a dematerialized form. Just like we want to keep our money with a bank, right? We would like to keep our money with a bank. So bank is going to hold our money. Similarly, CDSL and NSDL are going to hold my shares. I will have an account with NSDL and CDSL, and they are going to hold my shares in my dematerialized. Sir, I'll have my demat account with CDSL or NSDL, not with any typical bank, right? So that is a deposit. So depository is basically where the shares of the listed companies are deposited. So it is basically bank of shares. Okay. So similarly, there will be a depository in US. So what Infosys does is it gives the shares to the depository It gives the shares to the depository. How many shares, sir? 10,000 shares. Now this depository will take those 10,000 shares and it will issue a receipt. It will issue a receipt for every 100 shares. For every 100 shares, depository will issue a receipt that we so and so are going to, so and so are going to, 1 second, there is an issue. Yeah, I think we are good. Yeah, good to go. Yeah, so depository is going to accept the share from Infosys, and against those shares, it will issue a receipt. Receipt by stating that we have received so many shares of Infosys Limited, a company listed in India, having so many shares, having so much information, registered officer so and so location. So all those information will be stated. Now, this depository receipt, since it is issued by a US entity, now can I say it will be a acceptable security to be traded in the US market? Now can I say US investors will understand what this is, because that is issued by their own entity. That is issued by their own entity. So depository is going to issue 100 depository receipts, right? Because 10,000 shares were received by the depository. 100 depository receipts will be issued because one depository was stating 100 shares. The depository will give a certificate basically that we are holding 10,000 shares, and this certificate is going to be denoting in representation of 100 shares. Is going to represent 100 shares. Okay, so these depository receipts will be given in the US market. They will be issued in the US market, and now US market, once these shares, once these depositories are issued in the US market, the US investors will pay dollars. But whom are they going to pay dollars? They're not going to be paying dollars to Infosys directly. They will give the money to the deposit. They will say, we recognize you as a US entity, as an American entity, and we are ready to give you the dollars for it. Now, of course, the price at which this would be trading, that will be irrelevant to the forex rate or foreign exchange rate, right? So, for example, if I tell you one share of Infosys, let's say if it is for 7,500, for example, and we have $1 is equal to rupees 75. Okay, so these two is the set of information that I'm providing you. One share is 7,500 and $1 is rupees 75. So can you tell me one depository receipt is equal to how many dollar price? I will wait for your answer, guys. One share of Infosys is trading in India at 7,500 and $1 is worth 75 rupee. So how much will be one depository receipt? Understand that one depository receipt is equal to 100 shares. 100 shares. So what will be the price of one depository receipt? Can I say, sir, one depository receipt, if it is 100 shares, it means 100 shares into 7,500 divided by, right? Divided by what's the foreign exchange rate? The foreign exchange rate is 75. So this is so many rupees. So you get to know that this is first up, value of this 100 shares will be 7,50,000 rupees, right? 7,50,000 rupees. And since $1 was 75, I'll divide it by rupees 75. So each depository receipt will be having a price of $10,000. Each depository receipt will have a $10,000. Right? So one share is 7,500 into 100 shares. So 7,50,000 is the price of the depository receipt in rupee terms. And in dollar terms, if you want, it should be $10,000. Okay. So these $10,000 or whatever the price that is decided, that will be given to whom? That will be given to the, or that will be collected basically by the deposit. And that depository will pass on the money to the Indian. Of course, the whenever we have a foreign exchange, whenever we have such foreign exchange thing, we give that money to RBI. So that dollar will flow to RBI. RBI in turn will exchange it for rupee, and Infosys will get rupee out. Okay, so that is how Infosys shares are getting indirectly listed in US markets, and Infosys is able to get money from the overseas market. This mechanism, this receipt that is issued by the depository is what we call it as a depository receipt. At a global level, it's global depository receipt. When you typically go and issue it in the US market, it's called as American depository receipt. I hope this is pretty clear to everyone. The mechanism of global depository receipt. Is it clear? Yeah. So we have American depository receipts, right? And then that can happen even in the Indian markets. You know, some foreign company wants to raise money from Indian market. It can also raise it through Indian depository receipt. Like for example, a company from Indonesia, maybe, right? A company in Indonesia, if it wants to raise money from Indian market, so it will issue the company's depository receipts in it. It will raise rupee base. Okay, so that's your international level GDR or global depository receipt, which is a source of owned funds. Okay, fine. Now, that's the owned funds criteria. Now, borrowed funds, again, it's a huge area. Borrowed funds, it's a huge area that we have. Again, that we're going to classify into two categories, international level and domestic level. First, let's talk of domestic level. Domestic borrowed funds. Domestic borrowed funds, first it is seed capital. Understand seed? Seed, which is, at a very basic level, you just have an idea of a business and you want to grow that business. So this is basically designed by IDBI, which is Industrial Development Bank of India for startups. This fund is basically interest free, but carries a service charge of just 1%. It carries a service charge of just 1% for first 5 years, and then it keeps on increasing. So it is interest free, but just 1% service charge for 5 years. So it basically gives you time for 5 years to grow your business without taking any financial stress. Now, of course, after 5 years, the rate of interest charged depends on the reaping capacity with a moratorium of up to another 5 years. So for 5 years, they just charge you 1%. Then they charge you interest after 5 years. And moreover, moreover, the rate of interest that they will charge, that will depend on how much capability the company has got. What is the cash flow that the company is having? And based on that, their rate of interest will be decided. And they even offer you moratorium for 5 years. After 5 years, they'll charge you interest. But for another 5 years, they will charge you interest, but you won't have any obligation to pay that interest. Okay. So that's basically for facilitating the startups in India. Okay, that's the seed capital, which is again a type of domestic borrowed funds. Then next is zero coupon bonds. Now, what is zero coupon bonds? See, generally in case of debenture. We all know what happens in case of debentures. So with debentures, we issue the debentures at some price. We get cash flow from it. That is, as a investor, we get interest from it, right? And then we redeem it as an company. As a company, it redeems it, right? So in case of a normal debenture, from company viewpoint, year zero, it will receive maybe 1,000. Then in year one, year two, year three, it will pay out maybe 90, right? And then in the third year, it will pay out 10, sorry, it will pay out 1,000. So this is a typical coupon or a debenture that happens. The company gets funds, then it pays out the interest, and finally in the third year, it pays out the final principal. So this is a normal debenture. This is a normal bond or normal debenture. Then we have zero coupon bond. Now what happens in a zero coupon bond? Zero coupon bond. In year zero, company will receive, right? Company will receive maybe 600. Year one, two, three, no payment of interest by the company, right? And maybe directly at the end of fourth year, company will pay out 1,000. So understand, it's a normal debenture in which there is regular payment of interest. In case of zero coupon bond, no payment of interest in between, final payment at the end. Final payment at the end. So basically 600 will be the cash inflow, and then 1,000 will be the cash out. Obviously, as an investor, you earn 400 over here. That you are earning 400 over here, because it's not that you're not earning interest, you are earning interest, but there is no cash flow in between. So these are zero coupon bonds, right? Okay. So you can say this is life, it's a fourth year. You can say the payment over here will be 1090. So that's a zero coupon bond. So if you understand this, here we say that the zero coupon bond is issued at 600 and redeemed will be 1,000. The company issued bond at 600 and redeemed at 1,000. Now, if I say that the par value of the bond is 1,000, if I say par value of the bond is 1,000, par value, if it is 1,000, then is the par value of the bond. Suppose, guys, if it is 1,000, then can I say the bond is issued at 600? So can you tell me, is the bond issued at a discount or at par? Is a bond issued at a discount or at par? Of course, at discount, because par value is 1,000 or face value is 1,000. That it issued at 600, it means it is issued at a discount and redeemed at par. Okay. So therefore, we say over here, zero coupon bond are no interest bond issued at a discount and redeemed at par. Like in our example, we issued it at 400 and received it at 600 and redeemed it at 1,000. Similarly, if I issue a bond which is for 30 years, I issue a discount, issue a bond which is at 30 years, and issue price is 10, par value is 100. So there is a huge discount gap between the issue price and the face value. So those are type of bonds which have a tenure very large. You need to be giving them a huge discount. And those type of bonds are called as deep discount bonds. And they are again a type of zero coupon bond. They are deep discount bond, which is again a type of zero coupon bond. Okay, fine. Then another case of domestic loan or long-term loan is secured premium notes. Secured premium notes are basically redeemable notes which are issued along with detachable warrants. Warrants need to be converted within time period notified by the company, usually within 4 to 6 years. So, sir, secured premium notes, they have a life of 4 to 7 years. And in that 4 to 7 years, remember there is a detachable warrant. Detachable warrant. Now, what do we mean by this detachable warrant? Listen. Detachable warrant means this is a debenture, and here we have a warrant over here. And warrant is having, let's say, life of 5 years. Okay. The warrant is having a life of 5 years. Now, this detachable warrant, basically, the warrant that is attached to it is a warrant that is attached. After 5 years, this warrant is going to be detached, and against this warrant, you will get shares. Against this warrant, you will get shares. So that will get converted to shares. So detachable warrants are going to be getting converted to shares, right? What about this, sir? This will continue as a debenture, but whatever was additional attached over here, that will get converted to shares. Okay, guys? So that's your secured premium notes. These are redeemable notes issued along with detachable warrants. Warrants need to be converted to equity, of course, usually in a time frame of 4 to 7 years. Okay, so that's your domestic criteria. Then we know what debenture is. One important term that we need to look at over here is some of the types of bonds that are issued. Uh, yeah, we know debentures can be, or the bonds can be issued in the market. So what we did over here, that was about the domestic bond market. Domestic, you can take even loan from the commercial banks. You can even issue bonds with a floating rate of interest, right? Uh, Now, there are some typical type of bonds which are having some fancy name. Okay. One is a Yankee bond. Remember this Yankee bond? It is issued by non-US banks and corporations in the US. So Yankee bonds are issued in US by non-US bank, right? I think there's a query. Kojima. Platelet wala Kojima. After detachable warrant becomes equity, the secured premium note cease to exist or continue as debenture. That will continue as debenture depending on the term that is stated in the bond. Like after 5 years, the warrant is converted to equity. For another 5 years, it may continue as a debenture, or it may be also a case that the debenture cease to exist after payment of the principal. So that's again customizable. The bond can be customized, or that again that will be stated in the terms and conditions of the warrant. So it may be the case that warrant and the bond is getting converted at the same time, or the warrant just gets converted, but the bond continues. Okay. Now, yeah, these bond names we need to remember. Yankee bonds. Yankee bonds are basically issued by non-US bank in US. So, for example, if an Indian entity, let's say Reliance Industries, goes to US market to issue bonds in US market. Now, of course, bonds in US market cannot be in rupee denomination. That has to be in dollar denomination. So, when Reliance goes to USA for issuing bonds in dollar currency, those bonds are called as Yankee bond, or we'll call it as Reliance Yankee bond. We call that Reliance Yankee bond. If Reliance goes to Japan, those will be called as uh, you know samurai bonds, or against the Reliance samurai bonds. If Reliance goes to UK and raises funds in the form in pound currency, that will be called as Reliance Bulldog bond. Similarly, can you tell me which country would be denominated by maple bonds? If I ask you which country would be denoted by maple bond, just like Yankee bond was for USA, samurai for Japan, bulldog for UK, maple bond will be for which country? Just a general question. Maple, MAPLE. Maple bond will be issued in which country? In which country? Nepal? No, no, not Nepal. Maple, guys. No, maple bond is for Canada. When you issue your bonds in the Canadian markets, that's what you call it as maple bonds. Yeah. Okay. Similarly, in Indian context, we have the masala bonds also, right? Masala bonds. So, what are these masala bonds? So, these are the bonds which are issued outside India but denominated in Indian rupee. So, we issue our bonds outside India where rupee is, where the other country allows it, right? Those are called as the masala bonds. Okay. Fine. Now we need to look at this really important concept of securitization. It's a really important thing, securitization. Let's try to understand it with the help of example. Okay, this is really going to be interesting, guys. Just pay attention right now. Let's say we have the balance sheet of State Bank of India. On the asset side, can I say State Bank of India is going to have, on the asset side, State Bank of India is going to have loans and advances in big numbers, right? Right? Yes or no? Balance sheet of any bank, for example, balance sheet for any bank, can I say majority of its assets are going to be loans and advances? Correct? Now, these loans and advances, have the bank given all these loans and advances to a single party? Have the bank given these loans and advances to a single party or to a group of entities? Right? A lot of entities, right? And even in these loans and advances, you'll have variety of loans, right? Home loan, car loan, or some commercial loan, some vehicle loan, or maybe some personal loan, some credit cards. So all those things are going to be over here. So let us take an example in which State Bank of India has given home loans to multiple customers to the extent of 1,000 crores. Okay, so let us assume that there's a multiple individuals, and the amount on this and the amount that is recoverable from these home loan customers is 1,000 crores. Total principal outstanding is 1,000 crores. and State Bank is charging 9% as the rate of interest. SBI is charging 9% as the rate of interest on this 1,000 crore loan. So can you tell me what is the interest amount that State Bank would be earning on this loan amount? What is the amount of interest that the State Bank is earning on this loan amount? Can I say 1,000 crores into 9%? That's 90 crores. So every year, the income for State Bank of India stands as 90 crores. Now, State Bank of India thinks, what sense does it really make? What sense does it really make for us uh, to keep this 1,000 crores tied up over here? Because what happens is these home loan customers are paying EMIs. They are paying interest at 9% to SBI, and SBI is enjoying it. Now SBI says, let me do one thing. Let me transfer this home loans to some another entity. Let me transfer this home loan to some another entity, which means that another entity will have the right to recover money from this home loan customer. Okay. So now a special purpose vehicle is created by State Bank, maybe named it as SBI Securities Limited. And now the agreement that happens between SBI and that special purpose vehicle is SBI transfer this entire home loan to SPV. It means SPV will now have the right to collect money from SBI. This special purpose vehicle will have the right to collect the money, to recover the money from this home loan customers. Now, what is the advantage that SBI has there? By transferring this loan to SPV, SBI will get 990 crores. Now you will say, sir, it's a loss. Principal outstanding was 1,000 crores. SBI sold it for 990 crores. So it's a loss for SBI. You may see that this 1,000 crore becomes 990 crores. So there is possibly a loss of 10 crores. But that loss of 10 crores is a calculated figure. But remember, sir, out of this 1,000 crore loan, are you sure that each and every individual is going to pay you the money on time? Are you sure that each and every individual is going to pay you the money on time? Are you sure that each and every individual is going to pay you the money on time? Of course, no. There are possibilities of bad debts. Okay? There are chances of uh, bad debts. And for that reason, to avoid that bad debts, SPV would have done its own calculation and it is offering 990 crores for this loan. So SPV takes this money, takes this loan by giving 990 crores to the investors, to the 990 crores to SBI. Now the question arises, sir, from where will SPV get money? From where will SPV get money? Because SPV, this special purpose vehicle, this new company, has to pay 990 crores to this bank. How is it possible that the new company is having 990 crores? How can SPV get 990 crores? Yeah, it needs to raise that money from somewhere. It needs to get the money from somewhere. And somewhere means getting it from the market, from the public, from the general public. SPV from the general public. Okay. So from the general public, the SPV will go to the market and it will tell that, see, I am going to take over the home loan of SBI. For that, I need the funds. So you guys pay me the money and I will give you bonds. I'll give you bonds, right? So each and every individual in the public will be given bonds. Okay. So they are given bonds. Now, of course, it will be collecting money from the public worth 990 crores, right? and each of the individuals who pay money, they will be given a bond. Now the money flows to SPV. That money is given to the home loan customers. That money is given to the SBI for takeover of the home loan accounts. Now, what happens is these home loan customers are going to pay 9% to SBI. Home loan customers are going to pay 9% interest to SBI. SBI will do one thing. It may retain some commission or it may not retain also. Let us assume that it gets some commission for this loan. It retains 0.5%, gives 8.5% to SPV. SPV will retain 1% and give 7.5% to the public. It will retain 1% and give 7.5% to the public. Now, the public who had got the bonds of SPV, right? Got the SPV, the public gave the money to SPV, and SPV in turn is going to offer them 7.5% rate of interest, right? So now it is advantage to the public also, because if they go and put their money in bank FD, maybe they'll get 6.5%. Over here they are getting 7.5%. That's pretty good. Over here we have commission being earned by SBI, and again SBI also having the liquidity, because instead of tying the money in this home loan, SBI is basically having the securitized money, 990 crores, and it can use this 990 crores for giving further, right? Right. So that's how this entire securitization process works. And because of this securitization process, the entire globe had faced a crisis in 2008, which is also called as the subprime crisis. It's also called as a subprime crisis. You can have look at this video on YouTube once you get a time after the session on subprime crisis. Okay, there's a subprime crisis. You can go to the YouTube after the lecture and you can just look at that video. Right? Are we clear with this securitization concept, guys? Is the securitization concept clear? Yep. Securitization concept, is it clear? Okay. Fine. Let's go for the next thing. That was this securitization process. Now, another way of one way of getting assets, is to go for buying an asset, or other is to go for leasing. Okay, so we have got a lease financing as one of the concepts also. Are we aware that there are two types of lease? One is the finance lease and other is the operating lease, right? Yeah, finance lease and operating lease. So finance lease is basically the scenario in which the risk and reward is passed on to the lessee. Operating lease, the risk and reward basically remains with the lessor. So risk and reward, basically almost deemed owner you become in case of a finance. Whereas in operating lease, owner remains the owner, right? And the other party just uses it. Now, risk of obsolescence, since it's a deemed ownership, the risk of obsolescence is borne by the lessee. Over here, it is borne by the lessor. Lease is non-cancelable in case of finances. Operating lease, it is cancelable. Any repairs or maintenance that has to be borne by the lessee. Any operating lease that has to be borne by the lessor, right? So there's a full payout. Lease is usually full payout. That is a single lease repays the cost of asset together. So this is basically a long-term lease in which you technically pay the value of the asset itself over in a staggered way. Okay. There are some queries. Let me just quickly answer that. In this case, SBI will also get the collateral security submit to customers with SPV. SBI will submit in case of securitization. You are saying the collateral will be there with SBI, but whenever there is any default, the proceedings to recover the money and to put the asset for sale, that will be undertaken by the SPV. Okay. So SPV has given right to recover money from borrowers, then how the borrowers will pay interest to SBI. SBI will be getting the interest, but it has to pass on that interest to SPV. Okay. Now, explain the floating rate. Okay, I'll do that. Floating rate bonds. Let's understand this floating rate bond. As we know, in case of a normal bond, uh, investors' viewpoint I'm talking of, told the correct answer. Muhammad Aslam told the correct answers of all MCQ. Okay, Muhammad. How credit period, Alok is asking how credit period given to debtors is investing activity. See, uh, Alok, when you give credit period to the customers like debtors, if you ask them to pay after a month or after 3 months or after 6 months or after a year, it means you're keeping that money with the debtor. You want to keep that money with the debtor so that he comes back again for sale purpose, right? So your money is tied with the debtor. So your money is basically invested into the debtors, and therefore that's an investing activity. I hope that is pretty clear, Alok. Yeah. So in case of a normal bond, uh, in year zero, an investor pays maybe 1,000, and then in first, second, third, fourth, and fifth year, an investor receives a fixed, let's say, 90 rupee. And finally, there is a redemption at a price of 1090. Okay, fine. This is a normal bond. Now, if it is a floating rate bond, floating bond, floating bond, here we say that rate of interest will be RBI repo plus 3%. Now tell me, RBI repo rate, is it a constant figure? Is it a constant figure every time or does it fluctuate? RBI repo rate, is it a constant figure or does it fluctuate? It definitely fluctuates, sir, right? So every year, rather every 3 months, it fluctuates. So if we consider year zero, an investor will definitely pay 1,000. But in year one, how much cash flow, how much interest the investor is going to get? Can I say that is dependent on RBI repo? That is dependent on the RBI repo. Correct? Right? That will keep on fluctuating. Correct? So RBI repo is going to just fluctuate. Yeah. So what interest the investor is going to get, that is not a fixed thing. So we need to take a reference of what is the repo value. In first year, we find that the repo rate is 5%. In second year, it is 6%. In third year, it is 5.5. And in fourth year, it is, let's say, 7%. So what our investor are going to get, the interest that our investor is going to get. Okay. So the investor, uh, yeah. So what our investor is going to get, how much rate of interest will the investor get? So repo plus 3. So basically 5 plus 3, that's 8%. And when we say 8%, it is 80 rupee as an interest. Then next year it's going to be 6% plus 3%, which is 9%. So that works out to be 90. 5.5 plus 3%, which means 8.5%. So that will be like 85 you're going to get. And 7 plus 3%, which is 10%. So basically you're going to get 1,100. Okay. So that's basically 1,000, the redemption price plus 100. So that's how the interest that the investor get, it keeps on fluctuating, and it's not a constant figure, guys. And these type of bonds are called as the floating rate bond. Okay, perfect. Fine. These are the floating rate bonds, type of a floating rate bond that we have. Then, yeah, the other ways of raising short-term funds from domestic market. Short-term funds from domestic market. One is said to be a commercial paper. There's something called as commercial paper. Now, what's a commercial paper? Commercial paper is basically, it's a money market instrument. Remember, money market means those are having a maturity of less than a year, less than 1 year. Those are said to be commercial papers. So an unsecured money market instrument issued in the form of promissory note issued by high rated corporates. The amount of commercial paper, it's not like some uh, uh, 1,000 or 2,000. The minimum amount that we have is 5 lakhs. Okay. So that is, commercial papers are supposed to be mandatorily having some credit rating. Treasury bills are short-term government securities. These are the government securities ranging from 14 days to 364 days. A company can accept public deposits. There are some public deposits also. Long term, if you want to go for long term debt from the public, you can have public deposits issued. Company can issue deposits to other entity also. There are certain overdraft facilities also. Cash credit is also another short term sources of funds, right? So we have this entire chart. You can go through this chart. I'll be uploading this after today's session. Right now, let me just probably run through few MCQ questions for more clarity purpose, right? Let me just open it. Let me just share the screen. Yeah, first one, first question. For callable and puttable bonds, which of the following is least accurate. Under callable obligation, callable bond, obligation is on the investor, and under puttable is on the issuer. Callable bond right is with the issuer and puttable right is with the investor. Under both callable and puttable, right is with the issuer. Callable bond gives a right to the issuer to redeem the bond before maturity. Now, callable and puttable. See, callable bond means uh, company has a right to redeem the bond before time period. Puttable means investors have the right to redeem the bond before time period. Now, of course, the first option stated callable bond obligation is on investor and under puttable obligation is on the issuer. In case of callable, who has the right to redeem the bond early? The issuer or the company. So, of course, the investor is under obligation. And in case of puttable, issuer is under obligation. But C is the least accurate because right is not with the issuer. In case of callable, right to redeem is with the issuer. In case of puttable, right to redeem is with the investor. Let's look at the second question. In case of drop lock bonds, dash rate bond will be converted to dash rate if interest rate dash a predetermined level. Again, we haven't covered that in this discussion, so I'll just let me clarify this. So in case of a drop lock bond, floating rate bond, it will be a originally floating rate bond, which will get converted to fixed rate if interest rate falls below a certain limit. Like if the floating rate falls below 10%, it becomes a fixed rate bond. It's basically a fixed rate bond as well as a floating rate. It's characteristic of both. Initially, it's a floating rate, but when there is a fall in interest rate, it becomes a fixed rate bond. Then, I think you should be able to answer this. Yeah. Bulldog bonds are issued in dash by dash. Tell me. These are issued in dash by dash. These are issued in UK by a non-UK company. In UK by a non-UK company. Okay, fine. Which of the following is the least accurate to be called as a method of venture capital finance? Venture capital, we know it's the startup type of thing. So equity financing is done. Generally, we as a venture capital, as a startup, you try to get an equity financing. Maybe in the form of a conditional loan you will be allotted, or conditional loan at a lower rate of interest till maturity, participating debenture. Of course, since it's a case of venture capital, we would not be offering our funds at a low rate of interest. We would like to have a higher rate of interest. So C is the correct one. Yeah, this should be good with it. You will be able to answer this. Which of the following is true with regards to securitization? Method to convert liquid pool of assets to illiquid securities. If it is not feasible, there is no active secondary market. An investor of marketable securities is called a SPV. Original borrower is aware of the investor of securities to whom his EMIs are paid. Securitization. In the process of securitization, you can do this only if there are public players available who are ready to lend the money. So it's possible only if it's not feasible. When the securitization is not feasible, if there is no active secondary market. If there is no active secondary market, you won't be able to sell your bonds in the market and raise the money. Then, with regards to commercial papers, it can be issued, we know, only by the corporate borrowers, and that too highly rated corporate borrowers. Cash credit facility, we know it is going to be issued only against tradable goods because it's a short-term loan. Certificate of deposits, these are The investor faces illiquidity as banks do not encash CDs before maturity because certificate of deposits are issued by the banks. Definitely, it's the least accurate. So they are issued by bank. It's not least accurate. It's true. Investor will face illiquidity. That's a false thing because investor doesn't face illiquidity because of certificate of deposit. Then euro bonds are the bonds which are denominated in the currency other than that of country in which they are issued, like our masala bonds. You issue the bond in a country, but the currency is different. Okay, so in US you go and issue a rupee bond. In Canada you go and issue the Australian dollar bonds. Those are euro bonds. Okay, so with that we are through for the day. Okay, we're through for the day. We'll see you in the next class possibly. Let me see if there are any queries. Vinay is asking, sir, how is the venture capital different from seed capital? How is the venture capital different from seed capital? Seed capital is at a very initial stage. Venture capital comes at a later stage. Seed capital is where you just have an idea. You don't have any workable solution. But venture capital comes in when you have a working model with you. Okay, when it is ready to be produced, then the venture capital comes in. Okay, fine. So with that, let's just stop here for the day, guys. We'll meet up again in the next class for the next topic. Till then, bye bye and take care.